My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You want to know the single most useless thing you can do in this business? Well, that's easy. The most useless thing you can do as an investor is to worry about what everybody else is worrying about. The flip side of this, though, is also true. There's no point in getting excited about something that everybody else is eagerly anticipating. Why? Because when the vast majority of investors agree that something's going to happen, well, that thing tends to be already priced into the stock market. While the real economy moves at its own sedate pace, you got to borrow money to build out equipment, then use that equipment to manufacture your goods, then transport them to retail outlets, then wait for the customer to come along and buy them. The stock market has no such limitations. Stocks don't quite travel at the speed of light. Well, how about the speed of thought? Well, they come pretty close. So the moment of preponderance of hedge fund and mutual fund managers decide that the economy's slowing or speeding up or flatlining, stocks start trading like that's the case, instantaneously. Usually it takes some time to build that kind of consensus, which is why you rarely see these moves happening all at once. But once the big institutional portfolio managers are on the same page about something, well, you can be confident that it's baked into the averages. And when I say instantaneously, I mean that week. It'll happen that week. Now, this is some basic economic 101 stuff. Now, I don't have a ton of use for economists as a profession. They tend to take a pretty ivory tower approach to the discipline, meaning they have all sorts of models for how the world's supposed to work. Also, they can be very boring. Sorry. But they rarely let the empirical facts get in the way of a good story. If the data conflicts with the model, economists have a bad habit of throwing away the data, not the model. However, as long as you keep that caveat in mind, economics can have some very useful concepts for investors. One of these concepts is what's known as the efficient markets hypothesis. This theory says that at any given moment, stock prices already reflect all the relevant information in the universe that's out there at that moment. And when some new piece of data comes out, stocks immediately adjust to reflect the new reality. You'll often hear index fund purists citing this theory to explain why it's impossible for stock pickers to get any kind of edge. Because whatever you know about a company should already be baked into its share price. Can't get an edge. As far as they're concerned, markets are so efficient that investing in individual stocks is basically the same as gambling. If everything you know is already priced in, that means your homework is meaningless. And the only thing that can push a stock higher or lower is some new piece of information that nobody knows. It has to be something totally unknown, because if anyone did know, they would have already acted on it already. Ergo, it would be built into the share price. That means under this theory, the only things that can move stocks are unknown unknowns, to use the parlance of former Defense Secretary Donald Rumsfeld. And if you're merely betting on an unknown unknowns, well, you might as well just play roulette. It's more fun. Again, that's why index fund advocates adore the efficient market hypothesis. This theory tells them that it's impossible for individual investors to consistently beat the averages. So if you want equity exposure, the only smart way to do it is by putting your money in a nice, low-cost index fund that mirrors the S&P 500. As anyone who watches the show regularly knows, I have no beef with that. Beyond Meat, beef, whatever. I have no beef with index funds. In fact, I think they're the best way for the vast majority of people to invest in the market. I've said that almost since day one of this show. Even if you've got the time and the inclination to pick individual stocks and manage your own portfolio, you should still direct a big chunk of your savings into a cheap S&P 500 index fund. It's the safest way to give yourself equity exposure, and it's perfect for your retirement accounts. Think of it like this. It's hard to be a good individual stock investor. It takes real work, but it's incredibly easy to be an index fund investor, right? Putting money in a 401k or an IRA, index fund territory. You can gradually contribute over time with every paycheck. And as long as you believe the U.S. economy keeps growing over the long haul, you can leave that money in index fund and check in. It might be once or twice a month. And I know people can use the IRA for stocks. That's fine. But I'm saying index fund, index fund, index fund for retirement. But get back on track. This idea that you can't possibly beat the market because the efficient market hypothesis tells us that stocks are already perfectly valued. I got to tell you something. Here's what I feel about that one. It's bogus. And the people who presume it, they know nothing. Putting aside the fact that I did consistently beat the averages nearly every year at my old hedge fund, giving my clients a 24% compound annual return after all fees over the course of 14 years, the simple truth is that markets are not perfectly efficient. They're often irrational. They ignore things and make mistakes and misvalue information every single day. And that's a major reason why you can make money picking stocks. These anomalies are good for your portfolio. Ironically, this core dogma of free market economics is a lot like communism. It makes a lot of sense in theory, but it doesn't necessarily work in life. So why the heck did I bring up the efficient markets hypothesis in the first place if it's such a boneheaded idea? Because even if it's not strictly speaking true empirically, we know for a fact that markets are all kinds of inefficient. All. And it's still a very useful idea. As an ironclad law of the universe, it can help us. As a rough guideline, it can lead us in the right direction. Markets do try to be efficient. They aspire to efficiency. When a company reports a fantastic quarter, its stock will immediately spike because that's the kind of data that can get baked in very quickly. When the Federal Reserve changes policy, tells us that it won't be raising interest rates as previously planned, that's huge news, and it takes longer to bake, as we found out at the end of 2018 when the Fed got cold feet about its continual rate hike policy. That took weeks and weeks to work its way through the averages. Stocks that benefit from lower rates, and there are a lot of them, will instantly soar. But it can take days or weeks or even months for the averages to fully reflect the new normal because it takes time for portfolio managers to reposition. They can't just go in and out. They have too much money under management. We're talking about huge slugs of stock here. No hedge fund or mutual fund is going to buy or sell them all at once. Sooner or later, though, we do reach a new equilibrium. So let me give you the mad money version of the efficient markets hypothesis. Call it kind of sort of efficient markets corollary. When there's a widely held consensus view about something, anything, be it positive or negative, you have to assume that view is already being discounted by the market. So when everyone's feeling euphoric about the strong job market, well, that's possibly baked into stock prices already. When everybody's worried about a temporary Fed-mandated slowdown, it's probably baked in. When investors are hunkering down in fear of a bad earnings season, don't expect stocks to get slammed on disappointing numbers. People already anticipated disappointment. In short, when all the talking heads and journalists and media-friendly money managers are telling you to be afraid of the same thing, you don't need to be afraid. Let everybody else worry for you. From the stock market's perspective, the fact that most investors believe something's going to happen means that, in a way, it's happened already. Yet it's so easy to fall prey to the groupthink when you're managing your own money. Emotions are infectious, like a communicable disease. When you see all sorts of experts coming on television and saying the same thing, while the newspapers print similar stories and your friends echo this stuff back to you, it's only natural to assume it must be true. And you know what? Very often it is true. But that doesn't mean it's going to move stock prices. By the time we get any kind of real consensus on an issue, that move is probably over. You missed it. The bottom line, if you want to be a better investor, don't tear your hair out fretting about the same thing as everybody else. Instead, you should worry about the things other people don't seem to care about, because the real threat is the one you don't see coming. Dave in Virginia. Dave.
Hi, Jim. How you doing?
I am doing well, Dave. How about you?
Good. Yeah, I'm from Virginia. I was born in Plymouth Meeting, and I was actually raised in Summit.
Oh my, we are doppelgangers.
Yeah,
I love that.
Flip-floppers. We want to leave half our assets with a certain minimum amount to our two children, and retire on the other half. They were both in their mid-20s, and we will adjust our lifestyle if we have to in order to leave that minimum. Now, most money managers would say that at our age, in a normalized interest rate environment, we should be about 60% in stocks, and the kids should be around 85%. So without setting up new trusts, shouldn't we invest the minimum amount as if it were their money now? And if so, allocate stocks half at 60% and half at 85%.
I think the 85% all in for younger people is definitely right. For you, assuming you're my age, I think 60 to 65, we'd certainly feel like that we're going to go longer than the actuarial table. So I prefer always to put a little bit more stock in there than most think. If you wanted to go 90 for 20-year-olds, I would bless that too. We got to have those long-dated assets in there to make a lot of money over time, and thank you for the kind comments. Let's go to Frank in New York. Frank.
Yes, Jim. Thank you very much. This is first time, long time.
Okay.
I like to ask you, what's the difference between general stocks and over-the-counter stocks, and
Well-
should I view them differently?
No, I mean, they used to be very different. One was a bid and ask that was done by different, with my day, when I was at Goldman, we had over-the-counter was a little bit different from the listed. These days, they really have blended. I wouldn't worry about it. Just stay focused on the fundamentals. All right, hey, listen up. Don't sweat what they're all sweating. Pay attention to what others are ignoring. On Mad Money tonight, to trade or not to trade, that is the question. I'll tell you how to come out on top by pointing the different ways to approach investing. Then feel like the market's sometimes speaking a different language? I'll tell you how to decipher hidden messages in the tape. And the next time you see a hot IPO, well, should you consider buying the company or not? Not so fast. I'll tell you why. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.